Welcome back, everyone, to the Risk Intel podcast, powered by SRA Watchtower, where we share risk intelligence with experts from across the banking industry. I'm your host, Ed Vincent, CEO at SRA Watchtower. Hello, welcome back to the Risk Intel podcast. I'm Ed Vincent, and with me today, I am thrilled to have back an experienced guest who's been with us a few times, Shawn Ryan, who has a pedigree as a risk practitioner in a large financial institution, having worked in a community bank, hands-on, and now Shawn wearing the risk officer hat at a RegTech in our SRA Watchtower. Shawn, thank you very much for joining us today.
Thank you very much for having me back, Ed. I'm thrilled to be included again and to chat this lovely Wednesday morning.
Shawn, you recently attended the Independent Bankers of Texas Connecting Leaders Conference in San Antonio, and you were on stage there talking about the May 2024 Fed, FDIC, OCC, joint interagency guidance there that was published around third-party risk management and the guide for community banks. And we had Phil Goldfeder from the American FinTech Council on the podcast shortly after that had occurred. And one of Phil's observations was that anytime the FFIC is coming together and producing content, that's a good thing. It means they're paying attention to this, and they're giving us more feedback on how to enact controls and programs with these third parties. So you spoke a bit about this at the IBAC conference, and so today I'd like to dig into that a little bit and get your view on the guide itself, and so maybe we'll unpack that a little bit.
Sure.
But then I'd also like you to share some of your observations as a practitioner, as someone that really is living this inside a RegTech firm today that is interacting with community banks. So you've put this into practice. So let's go back to the guide itself
Yes.
and pick up on that.
Yeah. So the guide, of course, was released in May of 2024, following more detailed guidance that was released in June of 2023. And I have a chance to talk with a lot of bankers in my role. And one of the things they expressed is a little bit of frustration with the guidelines that came out in May of 2024. And I think that's a bit of a mistake there, right? The fact that the joint agencies have decided to release guidance and then refine it is an illustration that they know that financial institutions, in order to be competitive in today's environment, they have to work with financial technology firms in order to do business and to remain relevant to their clients and their customers. And so the fact that the regulators want to clarify things and help banks do this well, I think is good news. I think this is the best piece of advice here is an old one. It's do this, right? Talk to your bankers, talk to the financial solutions providers, read the regulatory guidance, look at the consent orders that come out, and figure out what the regulators are focused on. But the fact that the guidance is there is evidence that the regulators want to help the bank to get this right.
Right. So the guidance came out last year,
Mm-hmm.
and then this guidebook, if you will, right, comes out in 2024, and this guide is really trying to take the theory and the concepts and put it into practice. So there are, right, a number of chapters or concepts here that are talked about. One of the things that you and I have talked about is the importance really of the planning and the termination pieces before you even get to the other areas of due diligence, right? Contracting, monitoring. So maybe start with
Yeah. I think that's really important, right? First of all, it's written as third-party risk management guidance, but they talk about highly risky critical activities, and highly risky critical activities are typically those activities that the bank will look to new and innovative solutions providers in order to address, or in order to deliver. So that's reg speak, if you will, for fintech. And that is intentional on the regulator's part, because they realize it's extremely difficult to define what a fintech is or a reg tech is, like SRA Watchtower. But by saying highly risky critical activities, they open the window to all of these things that you're trying to do in order to remain competitive and innovative. And as you pointed out, I think one of the aspects that comes across very strong in the guidance is the importance of the beginning and the end, the planning, right? Before you
Right.
decide to engage with a third party to do one of these highly, and I'm going to use highly risky and critical activities in conjunction with fintech or reg tech, because the other ones are harder to say, right? So if you decide you want to do business with a fintech, you really need to focus on the planning stage. And that planning stage, of course, in a well-governed risk model, starts with the board, and it starts with the executive team, right? They need to define what it is that they're looking to accomplish by working with a partner, a third party. And one of the things that I'd like the financial institutions to think about is, you can work with well-established fintechs who are publicly traded, who have been in business for a while. That's certainly a strategy, and that's certainly a lot of financial institutions do. Think of Zelle as a perfect example, right? That is a payment provider like PayPal or Venmo, but it's one that a lot of banks use in order to provide that service to their clients. That's fine, you can do that, but there's less innovation there because every other bank around the corner has an access to that kind of tool. So during this planning stage, I think it's important for the board and the executive team and the front line to figure out what it is that we're trying to accomplish. Are we trying to add a service to our stack, to offer to our customers, to maintain, consistency with the rest of the competitive landscape, or are we trying to be innovators? In which case, if you're trying to be innovators at this planning stage, you have to recognize that there's going to be certain compromises you have to make, if you will, with respect to what your partners can provide to you, because oftentimes the fintech is a startup, or been in business for only a couple of years, is venture capital funded, is small, may not even be profitable yet. And so when you think about the steps of managing the third-party relationship with respect to risk management, you should have an upfront conversation during the planning stage to understand what it is you're willing to accept as a financial institution. As always is the case with risk management, you need to define your risk appetite. You need to do it well, and you should spend some time at the planning stage doing that.
Well, you connected the dots there with risk, and really the world that we live in as a business, that it is in that planning stage. It is going back and looking at the strategic plan, understanding the objectives, right, of that relationship. Why are you doing this, right? What are you trying to accomplish? And then going back to really your North Star, if you will, your risk appetite statement as an enterprise risk committee, as a chief risk officer, as a CEO, as a leadership team. It's one of the things that Nikki and I are talking about on another podcast. We've talked to Tyler Phil from Service Credit Union on the importance of that risk appetite statement. So that really is the grounding document, if you will, to say, all right, what are we trying to accomplish, but what are we able to tolerate, right? It is, I think you've talked about this in the past, that, right, risk isn't a bad thing per se, right? You have to take risk in order to achieve a reward.
No, and you mentioned the conference that I recently spoke at, and I started my presentation there with the risk and return function, which is you want to, if you want to make decisions that place you on or above that function line, right? You either want to get the amount of return that you should for the risk you're taking on, or frankly, if you're really good, you want to get more return than the function, than the market line for the risk you're taking on. And we believe that the tools that SRA uses, the practices that SRA preaches, help institutions do that. So yeah, it all starts with articulating your risk appetite, and that isn't to say that you shouldn't take risk, right? The regulators don't want you to not take risk. They recognize that we're operating businesses. What they want you to do is to be clear about the risk you're willing to take, and be clear about the actions you will take if your risk exceeds your tolerance. And if you are doing that and you have a way to measure that and monitor that and respond to that, which is kind of the rest of that third-party risk management cycle, then you're well managed from a risk perspective. You're being deliberate and thoughtful about the risk that you take on, which I think is the point, right? We want to be thoughtful about the risk that we take.
Yeah. All right. Let's take then this planning concept and tie it then to termination, right? Because those things really go hand in hand. And we can come back to the stuff in the middle, but it feels like those are right. Those are that's really one of the things that the agency is saying, you better prepare for this inevitable outcome, because like it or not, it's probably going to happen.
Yeah, you remember, our friend, everyone's friend, every business person's friend, Stephen Covey, begin with the end in mind. That's one of his maxims. During that planning stage, you actually ought to be thinking about what happens when it's time to terminate this agreement. And this isn't always a termination for cause or a termination for breach. It could be that you entered into this partnership to learn some new skills or to bring some new talent into your organization or experience into your organization. And now that you have it, it's time for you to move on. So, you might, what you should be thinking about at the termination stage is, certainly does my contract, right, during the negotiation stage, did I negotiate a contract in such a way that if the third party fails to meet my performance expectations, the reason that I went into business with them, or my control expectations, are they managing risk the way I expect risk to be managed, and my regulatory, the folks who are going to oversee my institution expect risk to be managed? Those things need to be built in. You need to have a mechanism to get out of the contract if they're failing to perform or they're failing to manage risk effectively. But you also need to think about, you also may want exit for convenience if you've matured as an organization now, and now you no longer need that third party. And so you could think of termination because of merger and acquisition, and now you acquire an organization or you're acquired by an organization that has that capability or functionality that you once needed a third party for. So you need to think about those things during the planning stage. Think about what termination might look like. You need to build your termination, your exit strategy, so that you can get out of an agreement for performance or failure to control risk effectively. You need to decide whether or not you are going to then move to another provider of that functionality, or that financial technology or regulatory technology functionality, or whether you now are going to be able to bring that in-house and build it or manage it yourself. And you should know going in, you should take some time going in thinking about that. It might also mean if you did a process of selection, right? If you did after planning, if you went to due diligence and selection, and you didn't just do due diligence on a single financial technology company, it may mean that you're staying in touch with some of those folks who didn't meet the bar the first time to see if they meet the bar now, right? So, don't conclude your due diligence and say, I picked SRA Watchtower, I'm not going to go and talk to or think about or pay attention to any of these other organizations. Actually, if you pick SRA Watchtower, it's okay for you to do that. You don't need to worry about anybody else. But when you're done with your due diligence process and you're done with your planning and your selection process, it's probably a good idea to stay at least familiar with those organizations that didn't meet your hurdles at that time, because they may mature more rapidly than the organization you're working with. They may become more innovative. They may develop some new functionality that you were looking for at the time. So you need to pay attention to those folks. And you need to be ready to execute that termination strategy at any point in time for any of the reasons that we've talked about. You're mature, you've acquired somebody, there's been a breach, there's been a missing of misperformance characteristics, right? All those are good reasons, but you don't want to be sitting here knowing you have to terminate and not having already thought about that stuff. And so planning and termination, to me, when I look at the guidance, those are the things that the regulators are really saying, let's make sure the banks who are doing this stuff, who are using third parties for highly risky, critical activities, have thought about the end before they begin this process. And so I think planning planning and termination, or planning and beginning with the end in mind, are critical to good third-party risk management.
I love the characterization, if you will, of termination is really another beginning, right?
100%. Yeah.
And the fact that it is, there may be, it may indicate that something has gone awry, but it also could indicate that this is the natural progression. This was the plan. The plan was we were going to learn from this, and now we're going to begin the next chapter. And so staying in touch with what's going on in the marketplace, and having the foresight, if you will, to say, right, what does chapter 2 look like, or what could chapter 2 look like? And thinking about that up front I just think it's just a different way to think about termination.
Well, I even forgot one other reason for termination that I didn't mention. I'll just add it here. I hope I don't destroy your thread. Sometimes you tried something and it isn't right for you, and you just want to discontinue that activity, right? You just decide.
Right.
And so, a termination for convenience clause, if I think about the number of banks that we are familiar with who thought that they were going to go heavy into digital assets or
Right.
cryptocurrencies, and then quickly decided, actually, no, we don't want to do that. We no longer have that risk appetite, right? It's why there's, the regulators provide a circular reference here, right? You come back to the planning process often and ask yourself the question, do I still have the risk tolerance that I had when I started? And that was clearly an indication that some organizations decided they no longer had a tolerance to try certain types of assets, offering their clients certain types of assets. And so they stopped. And you really hope that both the partner and the institution had a way out of those relationships that left both of them relatively whole for having tried. That's why the due diligence, the contract negotiation, the ongoing monitoring, the other stages in the third-party risk management lifecycle are also important.
Right, Shawn, you've given us, I think, a great teaser there. We've covered quite a bit of content here with the planning and the termination pieces.
Sure.
Let's put a pin in that. And I think that we're gonna wrap this episode here, but ask folks to come back for our next episode.
Okay.
And let's pick up those pieces in the middle. Let's pick up due diligence, contracting, monitoring, and then let's also go to the next stage here and talk about your experience in those areas as a risk practitioner inside of RegTech. So Shawn, thanks for setting the stage here with the planning and termination piece, and look forward to having you back for the next episode.
Excellent. Thanks for having me, Ed.